Lifestyle of a trader can be just wonderful, but it also has a lot of pressures. People are always asking me, Larry, how do you handle the emotional aspect of this trading? And they think it's because my emotions are one way, or I'm real cold-blooded, or whatever it is. But here's the real secret behind controlling your emotions. If you're getting really emotional about your position in the market, it's not the market. Before you knew about the markets, the stock market would go up or down, or gold would go up or down. Did it ever bother you? No, it never bothered you. So two things are at work here. One, your ego is at risk because you think the gold's going to go higher and it doesn't, and maybe you're long the market. And more importantly, if you actually have a physical position, you're long gold or you're short silver, you have money on that market to move in that way. That's why you become emotional. Not because of the markets, but because of the bet, if you will, that you have in the market. So if you're overly emotional, what does that tell me? What should it tell you? Your bet size is too big, not for your bankroll, but for your emotions. So make certain that your bet size, if you will, matches your emotions, and you'll be able to control and react as you should and when you should when it comes to short-term trading in the markets. Today I want to talk about the 4 important dominant powers in the marketplace. We're going to have 4 series here to teach you those groups, who they are, and how we can use them to become better traders. In just a moment, I'll teach you about the first one, the commercials. Isn't it wonderful? There are 4 groups whose actual buying and selling record we can follow and use that information to tell us when we should be long or short in the marketplace. The commercials are the most dominant. What do I mean by the commercials? Those are the people that commercially use or produce a commodity. That would be somebody that mines gold, somebody takes gold and refines it into jewelry, computer chips. That would be someone that grows wheat, or someone on the other side who takes the wheat and makes flour out of it, or bread, or crackers and chips, whatever. So those are the commercials in the marketplace. They're the largest player in the marketplace most all of the time, and they're not like you and I. They're not speculators. They're not trying to buy low and sell high. They're hedging their position in the marketplace. A farmer may have seen that the wheat is at $4 a bushel, his cost is $2 a bushel. He'll sell a lot of wheat because he's making money. He doesn't really care if prices go higher or lower because he is a hedger. So that's the commercials, and their record, which I've studied since 1973, the first person to write about these guys. I think I have more history with them than anyone. Their record is clearly, when they're substantially long, these markets rally. Substantially short, these markets decline. It's a great indicator for you to understand the markets. Now, the second group of players in the marketplace that I pay a lot of attention to are the large traders. It used to be large traders were people like myself that traded in large contracts, large positions. But that's all changed. A lot of things change in the marketplace. That's why you have to keep on your toes. The change is this. These large traders are now funds. The funds have the large dominant speculative position in the marketplace. And they all tend to buy about the same way. They like to buy strength and buy on the way up. Which means as the market tops, they'll have on a huge position. And when it starts to bottom and go up, they've been substantially short. So we can use them as well. They're kind of an opposite indicator of the commercials, but another really good indicator. We know every week from the Commitment to Trader report how many contracts are long, how many contracts are short. It's a marvelous tool. The third tool I look at from the Commitment to Trader report is the small speculators. That's people like you. And unfortunately, if they're not educated, they don't understand how to trade the markets. The small speculators are almost always on the wrong side of the market. With some exceptions, of course, that I teach in my classes. There's some markets where the small speculators are actually quite good. But by and large, the small speculators are very emotional, and they're heavily long at market tops and heavily short at market bottoms. So we can just do the opposite of those guys. That's the third group that we follow in the marketplace. There's one more. Let me tell you about it next. The fourth and last group in the marketplace that I follow are the advisors. The guys that write newsletters, blogs, advisory reports for brokerage firms, well, they don't tend to really do a very good job. If you look at their record over a long time period, they tend to be very bullish as markets get close to a high, very bearish as markets get close to a low. The first lesson I ever really got about stock trading and commodities came from my father, actually, who had worked in a refinery, didn't have very much money. But one thing he told me, he said, you know, my broker's always wrong. And wow, that's interesting. I thought brokers would know everything. But Dad's comment really I took to heart and have worked with for so many years is that the brokerage firm community and the advisory community really tends to just follow the trend. So they get really bullish late in the trend and very bearish late in a downtrend. So that's our fourth tool we can use in the marketplace to help us identify what side of the market we should be on. There are so many ways of looking at charts. You have point and figure charts. You have Japanese candlestick charts. You have Kingo charts, Ringo charts. It goes on and on. Line charts, bar charts. That's my favorite, bar charts. A bar chart simply shows with a straight line going up and down on your chart the day's opening price, the high of the day, the low of the day, and where prices close. That's why we call it a bar chart. I've been looking at those for over 50 years, and I really think that there's a lot of knowledge we can gain by looking at those charts. That's one of the things that I teach. Obviously not just one day chart, but we add a couple of those together, and you have a great insight from a bar chart on what should be happening next in the marketplace. The best market to trade? It depends. There's no one market that I trade all the time, and I think that's the secret to a lot of my success. In other words, I'm looking for the market that's the most set up now, has the best conditions now to rally. Sometimes it's gold, sometimes it's cattle, could be coffee, sugar, orange juice, whatever it is. But if you just trade one market all the time, it doesn't always have big moves up or down. So why not go shopping, if you would, for markets that are really ready to have substantial moves and trade that market in that direction until you've had that move. Then go look and say, oh yeah, this market's ready or that market's ready. Then trade that market. That's how you make money, and not just sticking with one market, because these markets, they have big moves. They go sideways for weeks, for months, for years, and you're still trying to figure out what to do, and you're missing all the other big moves. So find markets that are set up. That's the best market to trade. So I do get this question all the time. Larry, how did you take $10,000 to $1.1 million? How do your students that have gone on to win the same trading championship take $10,000 to a couple of $100,000? How did they do it? Well, we did it in really probably three things going on. First of all, we were very focused on the market. I was incredibly focused on the market that year. Secondly, I was correct on the market. I was in phase. I was in sync. I was with the market. I was in flow. And thirdly, we used an aggressive form of money management. Now, being good in the market takes study and research. Being focused takes a mental ability to be there right now. But the third thing, that's a mechanical thing you can be taught that we teach in our courses, money management. So the form of money management strategy you use is largely responsible for the large gains or smaller gains, and by the same token, the large risk you have in your account. So money management, that's how you take small amounts of money to very large amounts of money.